Alrighty guys, welcome back. Session 3 in the 10x Your Options Trading Series. Great to see you guys here. Today we're going to be talking about using Greeks and Greek ratios to enhance your trading return. So really important fundamental concepts we're going to be talking about today with the Greeks. We're going to dive into it in a lot of detail. Okay, before that, just a quick recap of what we talked about in session 2. We went over the weekly diagonal spread trading plan. So exactly how I personally trade that strategy and lots of past examples. We also looked at the bearish butterfly trading plan. Again, exactly how I trade that strategy and lots of examples. So I hope you guys enjoyed that session. And also talked about the core strategies that I use in my trading and when exactly you want to use those strategies. Okay, so the outline for today. We're going to go through all the Greeks. We're going to go through delta, gamma, vega, theta, and rho. So really lock down some key knowledge on those. And then I'm also going to go into the Greek ratios. Okay, really important stuff, particularly just learning the Greeks. The Greek ratios are a tool that I use in terms of risk management. It's not super essential if you're a beginner, but if you are a beginner, it's really important to have a bit of a knowledge of the Greeks. And don't worry too much about the Greek ratios, but it's something that I use, and it might open your eyes a little bit as to how I view my trading and how I manage risk. Okay, so that's what we're going to talk about today.
Talk about the Greeks. We're looking at delta, gamma, vega, theta, and rho. So again, the start of the session is probably going to be a bit of a review for some of the advanced guys, and then we're going to get into Greek ratios, which is really good stuff. It's something that I use religiously in my trading and has made a really big difference to how successful I've been in my trading. And I'm going to share with you some of the rules that I use and how I look at things. Okay, but before we do that, I want to talk a little bit about my trading. So this is something that everyone loves. I get asked these sort of questions all the time. So I've got a couple of slides to share with you guys on my trading. So I kind of call it the good, the bad, and the ugly. So had a period in sort of 2012, 2013 when it did really well. Had a really good return there in December 2012, 9%. Was trading a lot bigger and a lot more aggressively back then. So you can see there I had a really good run December through to March, roughly 32% in 4 months. But following that, had a really big loss in July of 8% in 1 month. And from there, I sort of decided, look, this is too volatile for me. I don't like losing that amount of money in 1 month. I had a big capital base at that time, and lost almost 10%, and sort of said, well, that's basically a new car that I've just lost there in 1 month. So that kind of just changed my thinking a little bit, and I try to, as I said in video 1, not aim for those really high returns, just aim for that slow, steady growth of my portfolio, around 1 to 2% a month, 12 to 24% a year. It smooths out the equity curve. You don't have those big drawdowns, and that's really the key. We talked about that in session 1, is how hard it is to recover from a big drawdown, both financially and emotionally. So I've scaled back my risk a bit in the last couple of years, trade a little bit differently. So that was some of the good in terms of a good return period. Always like to share some bad examples. I think people probably learn more from what can go wrong. There's so much information out there on options, and a lot of people will only ever share their winning trades, and you follow some people and you think they never have a losing trade in their life, and we all know that's completely false, right? If you ever find a mentor or someone like that who claims to never lose or hardly ever lose, that's instantly a red flag. Okay, so that's a little tip for you guys, because even the best people have losing trades. Okay, it's a fact of life. So this was one particularly bad trade for me back in September 2012, and I'll walk you through what happened. So basically I was too stubborn, didn't cut my losses early enough, thought I knew better than the market, and just held on too long. The stock moved much further than I thought possible, and I got to a point where I just couldn't continue to hold any longer while losses mounted. Okay, so this is the chart at the time. So I did a bit more directional trading back then and got into a trade here on that first red arrow. You could see we were really overbought Google had this massive run up from 280 up to nearly 340, so 20 odd percent in a couple of months. So I did a bear call spread, thinking that surely Google can't go up any higher. And the trade was okay for a week or so. It went a little bit higher, but more or less traded flat. Little bit of a pullback, and then all of a sudden sort of rallied higher. And should have really cut losses here when we got these big rallies, but I held on and got to a point on the second red arrow there, which is where I eventually took the loss. And you can see really, really overbought. And eventually I was right. The market or the stock did drop, and it dropped quite dramatically, but I couldn't hold on any longer. The losses would have just got bigger and bigger. So I had to take the loss where I did. And it just shows you can be right on your opinion, but if you get your timing wrong, you're still going to end up with a losing trade. So that's where that directional trading can be quite hard sometimes. You've got to be right on the direction and also pretty correct on your timing as well. So this was a bad trade for me. So again, just the lesson there, I guess, is that stocks and markets can move much further and much faster than you think possible. So even though we were massively overbought and had been for a month or so, the stock continued to go higher and get even more overbought. So keep that in mind. Just because a stock is overbought or has rallied a lot doesn't mean it can't rally further. And the same goes on the downside. Just because a stock's been crushed and is going down doesn't mean it can't go down further, okay? So the ugly, so this was my worst trade. So this was the one I mentioned earlier where I was down sort of 8% for the month. This was on the NASDAQ in July 2013. I took on way too much risk. So I had a delta dollar exposure going into this particular day of 350,000, which I'm going to talk a lot about delta dollar exposure in the later slides. But basically this was sort of how much risk I had in the trade on a dollar basis, which was just too high at the time. I was short, so I had a bearish trade on, and woke up in the morning, checked my phone, and something had happened. I think the Fed had come out with another announcement that they were going to do some more QE. Maybe it was QE3 or something. I can't remember exactly the timing, but QE2, QE3, something like that. Check the futures. Futures are up about 2%. So I've got a $350,000 exposure on the short side, and the markets are going to open up 2%. So I wasn't a happy camper. And I've got there, the third bit was vacation. So I was actually going on vacation this day. So just an absolute complete disaster of a trade, right? And a really important lesson, and something that if I'm going on vacation now, I try to have very minimal or no positions. Anything that I do have open, I want it to be really low risk and stuff that doesn't need to be monitored. So we're actually going on vacation to Cuba. So I wake up in the morning, the market's open, I'm down massively. My delta dollar exposure has gone from 350,000 to 1.5 million in a matter of minutes. Okay, so not happy at all. I'm sitting there on the laptop trying to adjust this trade, try to figure out what I'm going to do, and again, stupidly, really just a perfect storm with this one. Instead of closing the trade, I adjusted it, and I thought, no, this is okay. We've had this big rally; it'll sort of settle down, and I'll pick up a big chunk of time decay over the next few days if the markets are sort of flat. So adjusted it, left this position open, really massive position, right? And we're on our way to Cuba. So I'm thinking that's okay. If something happens, I can log on, I can adjust the trade, I can deal with it when we get there. It's only an hour flight. So we get to Cuba, get to the hotel, sort of open up my laptop. There's zero Wi-Fi, right? So finally, I'm stressing out. My wife is not happy with me because this was a Friday. I think we're there for the weekend. Grandparents are watching the kids. So really, nice romantic weekend away. The entire time there on the flight, I'm stressing out. I'm like, oh, did I adjust it like I thought I did? Was that the right thing to do? Should I just close it? Absolute nightmare, right? Eventually get to Cuba, can't get on the internet. So we go find an internet cafe. Okay, great, got the internet. Try to log on to my brokerage account, and of course it's blocked because Cuba won't let you get on US websites. So the whole weekend I had no idea what the market had done, and we flew back on Monday, so I had exposure on Monday as well. and the whole time didn't know what was happening. Eventually checked my phone, when we landed, and luckily the market hadn't gone up too much further, so things were actually okay. I think I'd made back a tiny bit of money, but just an absolute disaster. Kind of, I wouldn't say it ruined the weekend, but it was definitely this black cloud that was hanging over the weekend. So that was a really important lesson. Again, don't take on too much risk. And this delta dollar exposure is a really key thing that I watch now, and these ratios that I'm going to tell you about. So this was an absolutely shocking trade for me, and I hope you appreciate me sharing this. That we all have bad trades from time to time, and this was definitely my worst one. And I love and I hate sharing this one. I love it because I think it's a good learning experience. It's a bit of a funny story, but I hate it because I hate reliving it. So this one was a good one. So this was when I made the trade, the first arrow there, got into the bearish trade. And again, looking back at these charts, I had absolutely no business being bearish at this point. The market had a bit of a sell-off. It was starting to recover. No reason to be bearish here. The market rallies pretty strongly. And, I was in a loss position even before the big gap. And, shouldn't have had the position open with that sort of exposure. And then here's the big gap up the next day, closed on the highs. And even a little bit higher the next day. But I think, the way I had adjusted it, I managed to get a little bit of profit back. But yeah, it was a big loss. So huge learning experience for me. Okay, so on to today's session. We're going to get into the Greeks. I'll go through some of this early stuff reasonably quickly because, again, it's a little bit of review for most of you guys. And then we'll get into the really good stuff towards the end. Okay, so delta, one of our key Greeks, it's the options, measures the options sensitivity to changes in the underlying stock price. It measures the expected price change of the option given a $1 change in the underlying. So we talked on Tuesday, if you've got a delta of 50, the stock moves $1, your option price is going to change by 50 cents. If you've got a delta of 20, stock moves by $1, your option price is going to change by 20. Okay, so a high delta, you've got a high exposure to price changes. Calls have a delta between 0 and 1. Puts have a delta between 0 and -1. So calls are positive, puts are negative. And delta, talked about on Tuesday, can be used as a rough probability. Okay, so if you're looking at an option with a delta of 10, it has a roughly 10% chance of finishing in the money. It's not exact, but you can use it as sort of a rough probability. Delta of 20, you've got about a 20% chance that option's going to expire in the money. Delta of 90, when I say 20, that's 0.20. We kind of shorten it to say 20, the 20 deltas, that sort of thing. So again, delta of 90, an option that's really far in the money, really likely that it's going to expire in the money because it already is in the money. It's got a 90% chance of doing that. Okay, so it's a rough guide for you. As an option goes further in the money, the likelihood that it will expire in the money increases. So we just talked about that. Therefore, the delta increases. So looking at an example, we've got some puts here on the left. 1600 put on Russell at the time was really far in the money. Okay, so we're right at -1. And the further we go out of the money, we get closer to 0. So these are a very low probability of expiring in the money. Similar with the calls, the 830 call, really far in the money, so we've got a delta of 1, and then the further we go out of the money, the closer we get to 0, very unlikely to expire in the money. And then around 50 is sort of the at-the-money strikes. That's roughly where the stock would have been trading at the time. The index, so probably 1255, something like that. You can see the calls around 50 delta is around that level, and the puts sort of 1260, 1255 as well. Okay. As expiration approaches, the stock will have less chance to move above or below the strike price. In the money, options will rapidly approach 1 for calls and -1 for puts as expiration approaches. Out of the money, options will rapidly approach 0 as expiration approaches. So here we've got a graph of some call options. So the at the money strikes around 60. The deep in the money calls, you can see 6 month in green, 3 month in red, and 1 month in blue. As you get closer to expiry, rapidly approaches 0, okay? And the out of the money strikes, so from sort of 65 onwards and 70, as time passes, they rapidly move towards zero, okay? Probably pretty basic stuff for some of you guys, right? Now, gamma, I touched on gamma briefly on Tuesday, and I said, you know, a lot of newbies probably don't really know much about gamma. They probably don't pay too much attention. And, you know, that's okay. Like if you're a beginner, you don't have to worry too much about gamma, but it is important. And as you get a bit more advanced, you can start to understand gamma a little bit more. But I guess the key takeaway, if you're a beginner, is if you have a high gamma, you've got a high exposure to price movement as well. Okay, so gamma is the gamma metric is the sensitivity of the delta to changes in the price of the underlying asset. So gamma measures the change in delta for a $1 change in price. So it's like the delta of delta, basically. So you know, how much is delta going to change is measured by gamma. So high gamma means your delta is going to change really rapidly. A low gamma means the stock moves around and your delta is not going to change much. So if you have a really high gamma, if you're short gamma, you don't want the stock to move around much. If you're long gamma, you do want the stock to move around a lot. Okay, so it's just something to be aware of. I talked on Tuesday, that as the expiration approaches, that last week, gamma is quite high. So being short gamma in that last week can be quite risky. It can be profitable if stocks don't do anything because you get lots of time decay. But if you've got high short gamma in that last week and the stock moves around a lot, you're going to be in trouble, okay? So gamma is delta's ugly cousin, and not many beginners pay attention to gamma, and it can do serious damage to your portfolio. So again, you don't have to understand in too much detail, but if you get nothing else than the fact that high short gamma can be bad if the stock moves around a lot, then that's the main thing to take away, okay? So just keep an eye on your gamma. If the delta is the speed at which option prices change, you could think of gamma as the acceleration. So some of you who've traded iron condors in the past might have noticed that you know, as the stock starts to move against your position, the losses start to accelerate. They get kind of exponential, and that happened with the NDX trade that I was talking about. So you know, I had a high delta. I also had a high gamma. The stock moved, and the losses got bigger and bigger. So it builds, it accelerates. So that's what the gamma is measuring. So options with the highest gamma are the most responsive to changes in the price of the underlying stock. High gamma equals big changes in P&L. Okay, so that could be good or bad. It could be good if you're long gamma, and it could be bad if you're short gamma. Okay. High gamma can be a good or a bad thing. Positive gamma is good if you get a big move, so gains accelerate exponentially. Negative gamma is bad if you get a big move. Losses accelerate exponentially. Okay, so hopefully that makes sense. Again, some of you may have experienced this with condors that start moving against you. Gamma is highest close to expiry. You may have noticed this if you have traded weekly options. They call the last week of an option's life gamma week. Okay, options have a very high price sensitivity when gamma is high. Okay, so kind of repeating myself here, but this is really important, and this is why I don't trade weekly options. You know, some people do it, and that's fine. Good luck to them. You can make really good money. Time decay is really, really high. But if you get that big price move, you can suffer a really big loss in a really short space of time. Okay, so here's an example I like to share that illustrates how gamma works. So we've got two iron condors that we're looking at. We're looking at a weekly iron condor at the top and a monthly iron condor at the bottom. Both of them are 10 points wide. Both of them have the short deltas at 10. So they're more or less an identical trade, other than the fact that one is short-term and one is long-term. Okay. So if we look at our initial position on the weekly option, our delta is -26 and our gamma is -4. Okay. Then we get a 2% move, a 2% down move. So we had negative delta, so a down move is good for us. Look what's happened to delta in this example. It's shot up to 62. Okay, so that's a massive change for only a 2% move. Okay, we've gone from having negative delta to all of a sudden having massively positive delta. Okay, so that's you know how gamma works. You've got a high gamma, your delta is going to change really, really quickly. And so that makes things hard if you're trying to stay delta neutral, right? If you're a delta neutral trader, high gamma means you're going to have to adjust a lot to get your delta back into line. And that might not be something that you want to do. That incurs slippage, commission costs, all that sort of thing. Okay, whereas we look at the monthly iron condor, delta started negative as well, -9, gamma's -2. So our gamma's in half of the weekly example. Again, we've had a -2% move. The delta's gone to 20. So we've gone to positive, but it hasn't moved nearly as much. So we've gained 29 deltas, if you will. Okay, whereas on the other one, we've gained 88 deltas. So the delta has had a massive change in the short-term option and just an okay change in the small one, in the longer-term option, longer-term condor. Okay, so there's a strategy you can do called gamma scalping, and again, this is quite advanced. It's not something that's really recommended for retail traders. It's something that market makers can do, but just want to share one slide with you guys on this, just to show you some cool things that you can do with options. And I've written some articles on gamma scalping if you haven't checked them out, but just briefly, it's a technique used by market makers and other professional traders, and I'll go into this strategy in more detail later. It requires traders to be really well capitalized, so it requires a lot of capital to do the strategy. So you can't do it if you've got $5,000 or $10,000 in your account, okay? Traders also need to have a very good understanding of how option Greeks work before undertaking this strategy. So again, not something I recommend for beginners, but if you want to learn more about it, I can share an article with you that you can have a read of. Might be interesting, but it's not really something that I would recommend you guys do, okay? All right, so Vega is the option sensitivity to changes in implied volatility. A rise in implied volatility means a rise in option premiums, and so will increase the value of long calls and long puts. Vega increases with each expiration further out in time. Okay, so this is again review from Tuesday, but typically as implied volatility increases, the value of the options will increase. That's because there's an increase in implied volatility suggests an increased range of potential movement for the stock. So the theoretical example that we looked at, $50 stock, 6-month call option with a strike price of 50. If volatility is 90, the option price is going to be really high. If implied volatility is 50, the option price is going to be in the middle. If implied volatility is 30, the option price is going to be low. So you want to be buying options when volatility is low. You want to be selling options when implied volatility is high, okay? Easy, right? Okay, so Rho, again, is the amount an option will change based on a 1 percentage point change in interest rates. Most traders ignore Rho. If you're trading short-term options, monthly, even 2 months, changes in interest rates are not going to have much of an impact at all. The only options that tend to be materially impacted by interest rates are LEAP options, long-term options, due to the change in the cost of carry. So if you're trading 1 year or 2 year call options, and that's a valid strategy, you can do, instead of doing covered calls with stocks, you can use a LEAP option instead, and it takes less capital to get into that trade. So that's a really valid strategy and a good strategy for your long-term portfolio. Potentially Rho might have a little bit of an impact or changes in interest rates, but generally 99% of the time people just ignore Rho, okay? All right, so Greek ratios, this is the really good stuff that we're going to be covering, so we'll get stuck into that. All right, so there's no single best way to trade options. There's lots of different ways to do it. Neither is there a best way to manage Greeks. Okay, the important thing to understand is why we should pay attention to Greek ratios and why we set certain guidelines in terms of Greek ratios. Another point to emphasize is not to get too hung up on specific Greek ratios. There usually has to be some level of judgment used, but knowing some of these key ratios will help you know when to adjust and help avoid big losses. So that's what we're trying to avoid here. And I'm going to share with you the ratios that I use and how I look at things. Okay, so the first one, really important one, this is delta theta ratio, okay? So the delta theta ratio is the most important one. It is literally the position delta divided by theta. With options income trading, we are aiming to maximize theta. We want time decay working in our favor. If we want theta to be the major driver in the trade, then we want delta to be very low in proportion to theta. Okay? A high delta theta ratio means price is the major factor in the trade rather than theta. So if you're a neutral trader, you're trading iron condors, at the money butterflies, even the trapdoor trade that I use. If you're sort of a neutral trader, short strangles even, you want theta to be the big driver of the portfolio, okay? You don't want delta to be the big driver. If you've got delta as the big driver, you've got a big directional exposure. You're becoming more of a directional trader. So if you're trading bull put spreads or bear call spreads, you're going to have a high delta and you're going to have a high delta theta ratio. If you want to be a neutral trader, which is the way I do things, you want to have a really low delta theta ratio. And if that starts to get to certain parameters that we don't want to hit, that's when we start to bring it back into line, and I'll show you how we do that. Okay, so Greek ratio guidelines will be different depending on the strategy and instrument traded. Okay, so we're going to look at a typical Russell iron condor, and my rule for that is I want to adjust when the delta theta ratio gets to around 30%. Okay, so that's really key number to keep in mind, 30%. That's the kind of cutoff point for me. Again, it's not a hard rule. Sometimes I'll use a bit of judgment, and I might go to 35 or I might adjust at 25, but that's sort of my ratio that's the key level for me. And just know that if you don't adjust when you hit 30%, and the position continues to move against you, losses can accumulate very quickly. Okay, so I get emails all the time from people who have let their iron condors go too far, and at that point the losses just get bigger and bigger really, really quickly, and it's really hard to do anything at that point. Whereas if you do something about it when the delta theta ratio gets to 30% or even 35%, generally you're going to be okay. You're not going to have that massive loss. Of course, if you're at 30% and the market gaps up a lot, or gaps down, whatever your exposure is, you can still have losses that way. So you've got to use judgment, but this is sort of a line in the sand that I have, that generally speaking, for a Russell iron condor and for my trapdoors, I don't want the delta theta ratio getting above about 30%. Okay, so here we've got a theoretical position, iron condor from back in October. And looking at this position, you can see that the condor is no longer delta neutral as the market has moved up. So you can see here the delta theta ratio is 33%. Okay, so that's calculated as, it'll be negative 38 divided by 115. So you can see our delta there on the whole portfolio, the total position is negative 38, and our theta is 115. Okay, so if we do 38 divided by 115, our delta theta ratio is negative 33%. Okay, you could leave the position as it is, but if the market rallies another 1 to 2%, the position could start to be in real trouble. Okay. So there's lots of different adjustment techniques, which I'll go over in more detail shortly. I've got sort of 10 key strategies for adjusting, but here's one possible scenario. So this iron condor we're looking at is sort of a typical monthly iron condor, okay? All right, so here's one scenario of how we could get our delta theta ratio back into line. So one of the 10 things that we can do. There is more, but sort of 10 is about the library of adjustment techniques that I use. The profit potential on the trade has been, closing half the contracts on the under pressure side. Okay, so we had 10 contracts on the calls and 10 on the puts previously, and we had a high negative delta theta ratio. So in order to cut risk, we've just dropped half the contracts on the calls. Profit potential on the trade has been lowered, but our delta theta ratio is back to 10%, and the trade is much safer now. If the market continues to rally, it's pretty obvious, right? You've got less contracts, your losses are going to be less. But delta theta ratio is a really good way to to measure that risk that you have, and also delta dollars, which I'm going to talk about in a second. Okay, so that's one way that you could adjust. We get that back into line. So our delta is now -8, our theta is 77. You know, our theta's dropped, our profit potential's dropped, but we're still going to make money in this trade if it expires in the middle, right? And our delta theta ratio is back to around 10%, which is great. Okay, before I move on to the next ratio, which is Vega theta ratio, I want to talk a bit about delta dollars. So this is again a second really key metric that I watch. Talked about a little bit earlier when I was looking at that NASDAQ trade. And delta dollars, some people find this hard. You know, it's not really that hard, but hopefully I can explain it well. It's really just calculated as position delta times the underlying price, okay? So if we've got a negative delta of 38, this was our initial position, we've got a price of 12.51. So negative 38 times 12.51.65 is roughly 47,391. That's our dollar exposure. So you can think of it as, you know, if I owned the Russell, or if I was short the Russell and I had delta dollars of negative 47,000, that's how much exposure. It's like being short $47,000 worth of the stock or of the index. Okay, so I'll just repeat that again. So delta dollars is calculated as position delta times underlying price, and we're looking at the entire position. Okay, I don't really care about the individual strikes. I look at the total position, negative 38 times the index price, or the stock price if you're trading a stock. That's our dollar exposure, okay? So, you know, if you've got an account size that's $10,000 and you've got a position on like this where your exposure is almost $50,000, the position's too big, okay? Your dollar exposure is too big. It's not the amount of margin in the trade. The amount of margin is the difference in the strike prices times the number of contracts. So the margin in this trade is what, $10,000 or something, right? Whereas your delta dollar exposure is different. It's a metric where you can see what your risk is in dollar terms. And I'm going to explain why it's important. Okay, so delta dollars can tell you roughly how much a position can gain or lose depending on how much the price moves. So if you've got negative delta dollars and the price moves up, you're going to lose money, and you can roughly calculate how much that's going to be. It's not an exact science because of our old friend gamma, but this is the rough calculation. So we know that, you know, with this position, if the market continues to move up, gamma is going to affect the portfolio as well. So our delta is going to get shorter and shorter, okay? The change in the delta is going to accelerate. We're going to go from negative 38 to negative 50 really quickly if the market goes up, okay? Hopefully that makes sense. But the rough calculation, if we want to know how much we could potentially lose, is the price move in percentage times delta dollars. So again, we've got a roughly $47,000 exposure. I guess you could think of that as a notional exposure, notional value. If for this position price moves up by 1%, the position will lose, and again this is a rough calculation, 1% times 47,000, or 47,391, equals $473.91. So if you're going into the day and this is your position and it looks like the futures are going to open up, you know that as the market opens, you're going to be roughly down another $473 on this position. In all likelihood, it might be a little bit more because gamma is going to affect the portfolio as well. Okay, but that's a rough estimate. If the market goes up 2%, it's going to be, your loss is going to be twice that amount. Okay. Similarly, if you've got this position open and the market goes down, so it actually goes in your favor, the amount that your position, roughly speaking, is going to come back to your advantage is again 1% by 47,391. You're roughly going to make back 473.91. Okay, so this position currently, would have been in a little bit of a loss position. You've got short delta. If the market drops, that's good when you've got short delta, right? You're going to make a little bit of money. You're going to start coming back towards a profitable position if the market drops. Okay, so we looked at a 1% move. If price moves, so we talked about if the price moves down, the position is going to gain 473, okay? If price moves up by 2%, the position will lose 2% times 47,391. So you're going to lose $947. If you've got a trade like this that's a $10,000 capital at risk, and you lose 947, it's roughly 10% of the trade, right? Or 1%, sorry. So that's just something that I look at, and I'll share rules with you for position sizing and what levels that I like to adjust when delta dollars gets to in the next slide. Hopefully that makes sense. Again, I can go over this stuff in much more detail. This is just sort of a little bit of an introduction, a little bit of a taster, but hopefully I'm opening your eyes to these things to keep an eye on, okay? And in this case, with a 2% move, in actual fact, the loss will likely be larger thanks to gamma, as the losses are going to accelerate as the position moves against us. Remember, gamma measures sort of acceleration. Okay, we get a big move, we've got a bit of negative gamma there, it's going to be bad for the position. The losses are going to start to accelerate against us, okay? Also note that this calculation assumes no change in the other variables, so no change in volatility, time to expiry, or any other variable other than price, okay? So again, if we go back, we're talking about, say, a 1% move against us, we're losing 473. It could potentially be a little bit less because we're short Vega. So as the market goes up, volatility is going to be dropping. So we might be okay a little bit. We might make a little bit less of a loss because volatility is dropping. Now, if it was the opposite, if we had positive delta dollars, positive delta of 47,000, and the market dropped. So again, the opposite situation. It's going against our position still, but the market's going down, and you've got an iron condor with short Vega. This loss could potentially be more because you're losing on the delta, you're losing on the price movement, but you're also losing potentially on volatility because the market drops, volatility is going to spike up. Again, that's going to hurt this position, okay? So what I'm talking about here in delta dollars and this potential loss, it's really just the loss from the price movement. It doesn't take into account gamma, Vega, or anything like that. It also doesn't take into account time decay. Maybe you pick up a couple of dollars of time decay, so your loss is a little bit less. But purely in terms of price move, a 1% move with this delta dollar exposure, for or against you is going to be roughly 473, okay? All right, so again, I'm going to go over this in much more detail. So a bit of an introduction for you guys today. Hopefully open your eyes. Maybe it's something you can start looking at. Start to be aware of this metric. Maybe you can use this in your trading. And I'm going to go over rules shortly. So rules can be developed to ensure your delta dollar exposure doesn't get too large. So for example, I like to keep my delta dollar exposure less than 150% of my capital balance. Okay, so that's just a general rule that I've got in terms of risk management. Now you might want to have that as 100%. You might not want to take too much directional exposure. I really don't want it to be getting up to that 150 level. I'm going to definitely be adjusting when it gets to about 100. So again, with this example, $10,000 capital at risk in this trade. Okay, now you generally wouldn't risk your entire portfolio on an iron condor, would you? I hope you wouldn't. But if you were, let's say you've got $10,000 in your account, you've put on this iron condor, you're risking your entire portfolio on an iron condor. Your portfolio is $10,000, your delta dollars exposure is nearly 500% of your account size. So that's too big, okay? Now, if you had an account size of 100,000 and you've got 10% of it in iron condors like this, so you've got a $100,000 account, you've got $10,000 at risk in this trade, your delta dollar exposure is 47,000. Okay, so in terms of your total portfolio, maybe it's not too bad. It's only 47%. Okay, so you've got to look at things on a position basis and on your total portfolio. Okay, I know this is a little bit confusing. There's sort of a lot to digest and a lot to take in, but don't worry, I'm going to be going over this stuff in a lot more detail. Okay. Again, another example, let's say you have an account size of, let's say 20,000 and you've got this $10,000 at risk in condors. So you're risking 50% of your portfolio in iron condors. Delta dollars 47,000. You're over 200% in terms of your total capital. Okay, so again, probably too high and you'd want to do something about it. These are all from Interactive Brokers as well, these screenshots, but I would assume most other brokers would have a similar metric. If they don't, again, really easy to calculate, 38 times 1251, okay, if you have to calculate it yourself. Okay, so we talked about a couple of examples, but again, another one, if your capital balance is 50,000, you don't want your delta dollars to get above plus or minus 75,000. Okay, that's a rough guideline. Okay, this is going to help you avoid blowing up your account, which is exactly what we don't want to do, right? We don't want to have those big losses. Can't drum it into you guys enough. You know, if you want to be a bit safer, you know, maybe you have a rule where you don't want delta dollar to get above 100%, and that keeps it nice and easy, right? If your account size is 50,000, your delta dollars is 50,000, you know you're getting to the point where you need to adjust, or you need to put on another trade that will reduce that delta, and I'm going to talk about that shortly. Okay, so covered a lot there. Again, any questions, email me anytime, and again, we're going to be going over this in a lot more detail shortly. Okay. For now, we're going to move on to the Vega Theta ratio, so very similar to the previous one, but this time we're looking at Vega. So the Vega Theta ratio is another important metric to keep an eye on. When this ratio gets too high, volatility is going to have a big impact on your portfolio. Okay, so delta theta ratio is really high. Delta is becoming a price is becoming a big driver in your portfolio. If your Vega theta ratio is really high, volatility is now the big driver in your portfolio. Okay, so another ratio that we want to keep an eye on. Again, we want theta to be the major driver of our trades and portfolio. If you have a lot of short Vega trades like iron condors, your Vega theta ratio can be quite high. You've got a big exposure to volatility. So adding some long Vega trades can help to bring the ratio back into line. I talked about that on Tuesday. If you've got lots of iron condors, you're a big iron condor trader, you've got a lot of short Vega, if implied volatility is low, the VIX is low, you know, you might want to add some long strangles or something to help offset some of that risk that you've got in terms of volatility in your Vega. And we can look at that in terms of our ratios. Okay, a good rule of thumb is to keep the Vega theta ratio to less than 400%. Now, these rules are going to vary depending on the strategy, instrument, and time to expiry. Okay, in our Condor example, the Vega theta ratio was 257%, which is okay. All right, so again, really simple calculation. Vega as a percentage of theta, we're well over double. Okay, 250%. Okay, but for me, my rule of thumb, 400%. As long as I'm not over 400%, you know, I'm okay. I'm happy with that. So this position's fine as it is in terms of our Vega theta ratio, but our delta theta ratio needs work. Okay, that's the problem here is that the price is a big driver in the portfolio. Okay, Vega exposure increases as you go further out in time. Theta also decreases. Okay, so this is what I'm talking about. You might have different rules depending on how you trade. If you're a 30-day Condor trader or if you're a 60-day Condor trader, you're going to have different rules, different ratios. And this is something that you kind of have to figure out for yourself. You know, I can give you my rules that I look for on my 30-day trades or my 60-day trades, but you might trade differently. So you might have a slightly different ratio to me that you want to keep an eye on. Okay, longer term trades will have a much different Vega theta ratio. For example, this 60-day iron condor has a Vega Theta ratio of 571%. Okay, so our Vega is pretty similar to the previous trade. I think it's actually even a bit lower. Can't remember what the last one was, but our Theta is much lower, so our ratio is really high. So Vega is a more of a driver in this longer term trade than it is in the shorter term trade. Okay, so if you're a 60-day trader, you're going to have a different ratio for Vega Theta. Okay, so you might have a rule of 600%. You know, this trade is fine as it is. You know, Delta Theta is also going to be different. Okay, because your Theta is much lower. So in this example, Delta's -23. Our Delta dollar exposure is a little bit lower, but our ratio is higher, okay, because that Theta is much lower. So if you're trading 60-day condors, you might have to be a bit more lenient with your Delta Theta ratio. Okay, you're going to have to come up with different rules of thumbs. But in terms of a standard 30-day condor, which is probably what most people trade, that sort of 30% rule for Delta Theta and 400% rule for Vega Theta is kind of a good rule of thumb, okay? And you can adjust it from there depending on how you trade. Okay, so a bit more on Vega Theta. 1 week iron condor here we're looking at now. It's got a much different ratio again, okay? Delta Theta ratio is 13%, so really, really good. Theta's really high, right? Because we've got 1 week to expiry, so lots of time decay. But also look at that gamma, okay? -11. So that's what I'm talking about with gamma. Vega Theta ratio is 68%. So really low Delta Theta ratio, really low Vega Theta ratio. So they're within those boundaries that I talked about, but don't be fooled. This is a very risky trade. Look at gamma, -11. Okay, you've got a huge amount of risk in this trade. And you can see just by looking at it, even if you don't look at ratios, you know, prices at 12.51, your short puts are at 12.20 and short calls at 12.70. You haven't got much margin for error. Okay, if price moves, you're going to start to have losses. Okay, so again, time frame is going to make a big difference in terms of your ratios. You know, maybe you do trade weekly condors. Maybe you kind of ignore some of the stuff that I talk about and you want to trade weekly condors. Then your ratios are going to be a lot different to what a 30-day trade is going to be and what a 60-day trade is going to be. Okay, so yes, these rules that I'm saying of 30% and 400%, it's a good rule of thumb for a 30-day condor. It might not make sense for a different time frame. Okay. Again, I know it's a lot to take in. We're gonna go over this in more detail. Don't worry. But also with different underlyings, you're going to have different rules. Okay. I'll show you a way where you can standardize things a little bit. Okay. But for now, ratios we've looked at so far were all positions in RUT, but the ratio is going to be much different for different underlying instruments. So let's look at a trade in GLD, for example. Delta Theta ratio, 270%. Okay, massive. We've got 84 Delta, and we've only got 31 Theta. So Delta is way higher than Theta. Okay, so in terms of our Russell rule that we had, this is way out of line. Okay, but look at our Delta dollars. It's only 10,000. Okay, so maybe that's okay. Okay, so you're going to have different rules for different underlyings, and it's because the price is much lower. Okay, and the Vega Theta ratio, you've got 2,187%, massive. You've got a massive ratio. So 678 over 381 over 2,000%. But you know what? Maybe that's okay with this trade, you know? So different strategies, different underlyings, you're going to have different rules for these ratios, okay? And I can't give you rules for every single possible strategy and every single possible instrument, right? It's something that you kind of have to just figure out for yourself. You can start with what I'm telling you as a guide for a typical 30-day Russell Condor, and then you can develop your rules depending on what strategies you trade and what instruments you trade, okay? So if you're trading gold, this is the short strangle on gold. If you are this type of trader, your rules and your ratios are going to be much, much, much different, okay? So get to know each underlying instrument that you trade, and you will soon learn the ratios for each. So when I trade Russell Condors, for example, I mean, it's second nature for me, these ratios. I know what to look for. Whereas when you're starting out, it's going to take a little bit more work. You're going to have to go, oh, well, is this reasonable? You know, I'm not sure. It comes with experience. Once you've done a few months, you'll be like, okay, you know, I'm trading an SPY condor. If my delta theta ratio gets to, I don't know, 50%, that's when I know that happened last time and I had a big loss. So I know I don't want it to get above 50%. Okay, so the rules are going to be different. It just kind of comes with experience. But you can use delta dollars to kind of standardize things. Okay, so you standardize your delta exposure. I'll show you how to do that. So you know, you could say you could divide delta dollars by 1,000 to get like a standardized delta exposure. So instead of looking at delta at 84, we might say, all right, we'll take delta dollars of 10,000, we'll divide it by 1,000. That gives me 10. So my true delta is 10. 10 divided by 31, you know, 30% or whatever. So maybe that's how you do it. You could pick any sort of nominal value. You could have 10,000 as your standardization factor. And again, that's kind of advanced stuff, but you know, that's one way that you could look at things. So we could say that even though the delta theta ratio here is really high, if we standardize it and we compare it to our Russell Condor, you know, maybe the delta theta ratio comes in a little bit less. Okay. So let's do that actually. So 10,000, let's say 1,000 is our standardization factor. Our delta is 10 divided by 31, roughly 30%. If we go back to our Russell, standardization factor of 1,000, our delta is going to be 47. 47 divided by 115, we're still pretty high, right? We're still 40%. So that's how you can compare the delta exposure between the two positions. You kind of standardize that delta dollars number. Okay. Also, we can look at the overall portfolio. So as well as looking at the Greeks and the Greek ratios on individual positions, we're also going to look at them on the overall portfolio. Okay, and again, you'll develop rules and ratios that you're comfortable with. They might be different to the rules that I use. I can kind of give you a guide of what I do, but everybody's got different risk tolerance, right? Okay, for example, let's assume we have a number of positions open in Russell in various expiration dates. Okay, so you see the image below. I think I set up some sort of standard condor trades, different expiries, October, middle of November, end of November, okay? We determine that our delta dollar exposure and our delta theta ratio is too high. We could adjust some of the existing position, or we can layer in another position that helps bring our exposure down. Okay, so this is a bit more advanced stuff. Rather than just adjusting one position, we can actually add to the portfolio to bring some of this stuff down. So, you know, maybe in this example, your account size is 75,000 and your delta dollar exposure is up at 100,000. So your delta dollar exposure is too high for your account size. And what you want to do is you want to bring that down. And you've standardized your delta dollar ratio, your 97 divided by 259, you're still too high. So you want to do something to bring that ratio down. Okay, so just as a pure theoretical example here, we could add an SPX bull put spread, helps bring the delta dollar exposure back close to zero, and our Greek ratios are looking much better. So this is before our adjustment, our delta dollars, and again, once you start adding different instruments in, you have to look more at the delta dollar number rather than the actual delta, okay? So here we've got delta dollar of 97,000 and a delta of negative 78. We add the SPX trade in, bull put spread gives us positive delta. Now our delta dollar exposure is down to negative 11,000, so much more reasonable for that sort of portfolio. We haven't had to adjust our other trades, so this is something that you can think about doing, okay? And what I'm talking about using delta dollars instead of delta, here our delta dollar is much higher than our delta. It's much more than 1,000 because of the price of the underlying. And here it's now less than the delta because the SPX is much higher, okay? So a 40 delta on SPX has a much different notional exposure because the underlying is higher. Does that make sense? So, you know, 86,000 delta dollars is a much higher notional exposure for that level of delta. Okay, so different underlyings, different rules. Okay. All right, don't know about you guys, but I am exhausted. That was a lot to go over. And don't worry, I'm going to cover this stuff in more detail. Any questions?
Alright guys, thanks for watching. Really hope you enjoyed that video, and do make sure you stay tuned. I've got lots more good stuff coming your way, lots more stuff to help you out in your trading. So I'll talk to you soon.